This kitchen appliance stock, it crashed 45% and then ripped 40% higher in under 4 months. TTK Prestige, the company that makes you pressure cooker, just flagged a golden crossover on the daily chart. But the profit is still down at 47% from its 2022 peak, and the stock trade close to 50 time earnings. Real turnover or the short-term spike, is it about to fade? We have a full breakdown, cause of the crossover, fundamentals, valuations, and my personal take. Without wasting time, we can quickly get into the video. If you're new to my channel, please do subscribe it. And if you like this video, please do hit like button. Let's go. Why golden crossover? A 50-day average crosses above 200-day average. A signal reads as a shift to an uptrend. TTK Prestige, it fell from 52-week high of 772 rupees to a low near at 423 rupees to 428 rupees in March 2026. It is nearly 55% of the breakdown. The trigger of the bounce, a commercial LPG supply disruption, which hits several cities in March 2026. Hotels, restaurants, and the PGs, they are pushed to buy induction cooktops, demand on quick commerce apps, which jumped roughly 3x. TTK Prestige, it is a market leader in cooktops, 25% of the shares, which rallied cross to 30% in 3 trading days, and it is up 37% over trailing 3 months. The key point is this golden crossover, which is reaction to short-term demand event. It is not an fresh multi-quarter earning growth. We have to keep that in mind when we check the fundamentals. Let's understand growth and margin. When you look at the revenue, which is 1,745 crores to 2,974 crores over 10 years, the CAGR of just 6.1%. The screener itself flags 5-year sales growth, which is 6.27% as a poor one. The net profit, it peaked 305 crores in financial year of 22 to 112 crores in financial year of 25, and it recovered to 116 crores in financial year of 26. It is still 47% below the financial year of 2022 peak. The operating profit margin, it swung from 20.4% in financial year of 21 to just 6.4% in financial year of 2026. There is a real volatility from input cost and the competition, and not a one-off. Let's see the return ratios, ROE and ROCE. The ROE, it has fallen from 25.8% in financial year of 18 to just 8.1% in financial year of 2026. The ROCE, it is down from 31.9% to 11%. Why? 870 crores of cash and the investment is sitting idle on the balance sheet. Mechanically, it drags ROE down even though the core business is asset light. Let's check the cash flow quality. The operating cash flow, it is positive in all 10 years, no cash burn years. The investing cash flow, it is negative in 9 of 10 years, a real reinvestment into plants, not asset sales. A financing cash flow, it is negative in 9 of 10, dividend and debt servicing, not equity dilution. A 10 years cumulative operating cash flow, which is 2006 crores, which is almost exactly equal to a cumulative net profit, which is 2000 crores, a 0.96x of cash conversion ratio. Over last 5 years, it is actually 1.08x. So finally, there is no sign of profit or revenue manipulations. Earnings are completely backed with the cash flows. Debt, the absolute borrowing, it is up from 113 crores to 174 crores, which is over the decade. It is worth watching, but the debt to equity, it is still just 0.09x. 870 crores of cash plus the investment against 174 crores of debt, a net cash position of 696 crores. It is not an solvency concern today. Let's see the promoter integrity and the dividend. The promoter holding is steady, which is 70.5%, 0 pledges. The financial year of 26 filling confirms no encumbrance, no fraud or the governance issue found in this research. The financial year of 26 dividend, which is 7 rupees 50 paisa per share, the payout ratio is 64%. A dividend yield at the current price 671 rupees is about 1.1%. It is a modest and not a yield play. Valuation. The current market price is 671 rupees. A trailing consolidated EPS is 11 rupees 70 paisa, which implies a PE of roughly 57x on this screener data. A standalone basis EPS on the broker terminal, it which shows closer to 47 to 52x. It is an either way rich. The screener, it classifies TTK is under household section. The real peers are Butterfly Gandhimati, which is 52x, IFB Industries, which is 30x, Whirlpool India is 34x, Eureka Forbes is 46x, the Stovecraft is 53x, the sector median is 40x. TTK, it is at 47 to 57x. This is trading above its actual sector median. Price to book value of TTK is 4.6x versus the sector median is 3.7x. There is a real gap, but smaller than PE gap. The valuation follows 40 to 45%, a rally which is driven by LPG shortage demand spike, a possibly one-off event and not a structural margin or ROE improvement. Paying 47 to 57 for a 6% sales growth and ROE that is more than halved in 4 years, it is a demanding price, not a bargain. Okay, what is my opinion about this stock? It is a good business, but overvalued. A clean promoter record, a genuine cash back earnings, category leadership, but the margin and return ratios have weakened. Growth is slow and the market is pricing in a recovery. That hasn't shown up in numbers. This is purely how I am personally approaching it. It is not a recommendation for you to copy it. I am not chasing this rally at current levels. If I track it at all, it is very small, staggered weekly or bi-weekly amounts, not a lump sum amounts. I would rather wait for Q1 financial year of 2027. The results are due at 28th July 2026 to see if this demand spike shows up in a full quarter of earnings before doing anything is meaningful. If the valuation cools towards the sector average alongside a genuine margin and ROE recovery, I would revisit the case. Until then, for me, this stay on the watch list, not in the portfolio.